I know CPI yesterday didn't really change your inflation narrative, and I'm watching the 2-year once again 4.49, 10-year just above 4. Is it beginning to feel to you like those are going to be relative ceilings here for a while?
Yes, I think we are getting close to the peak 10-year Treasury yield for this cycle. I really think that's the one to watch as we think about the stock market, especially some of those longer duration assets like within the technology sector or growth stocks. We're getting incrementally more hawkish pricing from the market, now looking at a peak Fed funds rate pretty darn close to 5%. I don't think that moves much higher. And even, with that disappointing inflation read yesterday, we haven't really seen the 10-year move too much. So I do think it's possible we move a little bit higher, but I think the heavy lifting has been done here in terms of the massive repricing from the market on the Fed side and what we've seen in reaction from the 10-year Treasury yield.
Right. And we'll talk about sectors in a moment. But OK, if we got the terminal rate basically getting set aside, isn't now the issue of how long we hold here and what the impact is going to be on earnings for next year?
Absolutely. So typically when you're looking at a Fed rate hike cycle, you'd expect the market to start to find the bottom when you get to that peak rate, because it usually means that the Fed is then going to start cutting rates. And I think that might be a little bit different here, particularly given the importance and really the urgency behind the inflation story. What we've heard from the Fed is that they will get to a certain point, but not immediately start to cut. Of course, that's based on the data today. The Fed does not have the luxury anymore of using leading indicators to try to predict where inflation's going. But a lot of those leading indicators are still encouraging for a slower inflationary environment. And so I think when we actually get down to that time, at some point in 2023, when the Fed does level off, it will have to see if inflation is coming down quickly because growth is slowing dramatically, then we might start to see some easing off of the brake from the Fed. And all of that could help kind of ease markets and start to find that recovery period.
Hey, Meghan, I want to talk about growth tech. We sometimes call it unprofitable tech, or maybe not profitable yet tech, particularly because Nutanix right now is up 24% on questions about whether it is in play. Now, this is a stock that's been underestimated over the past couple months. It was trading, I think, down in the 17 area before its earnings report. It popped after earnings. It's higher than that now. And I'm also thinking about Vista's move for KnowBe4, which is now trading at 24. And it was in the 17 range just a few weeks ago. And I think the question is, even though some of these companies aren't profitable, if they're in areas like multi-cloud, like cybersecurity, and have unique technology, is there a point in getting into them now, either for the long term or in some cases, hey, private equity is stepping in and saying, this looks good?
Yeah, so I think there's two issues at play here. One has been, and it really comes back to the rate conversation. So one has been the velocity of the move in interest rates, and that's really what has shaken the foundation of some of those growthier parts of the market that don't have profitability. And then the other is the level of rates. So I would say from the velocity perspective, I think we've felt a lot of that pain. So I think you could start to see investors ease back into longer duration assets, less profitable companies. We are still looking within the growth sector for a lean towards valuation, so kind of that growth at a reasonable price type of dynamic, and a path to profitability, if not actual profitability. And I think the reason for that is because we are probably looking at a return to a more normalized interest rate environment. So, even if inflation comes off, we don't expect to return to those level of rates that we've enjoyed for the past few years that really gave fuel to that unprofitable tech sector part of the market. And so I think going forward, you really do have to keep an eye on valuations, but a lot of the growth that we are probably going to see in the tech space is going to come from some of these newer entrants. So finding the balance, I think, is really the key.
Right. We're always trying to figure out what the right valuation is for this, especially this unprofitable tech sector, if you will. And Meghan, what does it tell us that maybe there's some interest here in terms of Nutanix, in terms of M&A activity, PE interest, and some of these other names? Are we getting close to a bottom?
Well, we've already seen a 25% correction in the S&P 500. I think, there's a lot of negative headlines and a lot of people who are, putting out that really risky scenario that we have, some sort of spillover or contagion. That is always a possibility, but it's not our base case. And really even our downside scenario is for a mild recession. And so I think if you think about that, you think about getting to peak hawkishness, peak interest rates. I think that is why you're going to start to see investors easing back into some of these growthier parts of the market. And, bottoming doesn't happen on a day. We are reminded, back to the pandemic when it was literally a drop down and a slingshot back up. And I think this is going to take longer. So it is going to be more of a process. But I don't think that we have too much further to fall. And that's why I think you have to stay invested here.